If you're about to trade in 2026 without understanding what's coming, then you're flying blind. You know, that's a direct quote from market analyst Gary Glover, and it honestly perfectly sets the stage for what we're looking at today. We are staring down a year where some truly unprecedented, massive forces are about to collide. And if you don't have a very specific roadmap, you're pretty much guaranteed to get caught in the storm.
Welcome to this explainer. Today, we're going to synthesize a ton of complex data, from shifting macroeconomic trends and serious geopolitical risks, right down to historical market cycles. We're going to take all of that chaos and distill it into a clear, structured strategy for the year ahead. Here is our agenda for today. First, the 2026 market blueprint. 2, AI hardware versus software. 3, geopolitics and inflation risks. 4, the April-October danger zone. And finally, number 5, the asset allocation playbook. All right, let's dive right in.
Section 1, the 2026 market blueprint, bull versus bear.
So this year is entirely defined by a massive collision between two opposing forces. In the bull corner, you've got the explosive, nonstop growth of artificial intelligence. But in the bear corner, looming, highly complex systemic vulnerabilities. To really get a handle on this year, you kind of have to look at the market the way a meteorologist tracks a superstorm. We have this massive front of technological euphoria crashing head-on into a front of geopolitical peril. Our blueprint is basically the framework that combines these macro trends with historical cycles to forecast exactly when and where the lightning is going to strike.
Moving on to Section 2, AI hardware versus software, the great disconnect. Let's start with the bullish upside. We are witnessing a profound divergence within the tech sector itself. According to institutional data from FTSE Russell, we aren't just seeing a generic tech boom. What we're actually seeing is a massive shift favoring hardware, which is up 4.3% year to date. Meanwhile, traditional software is actually struggling, sitting at a negative 12.4%. You might be wondering, why the huge gap? Well, the market is frankly terrified that AI will ultimately disintermediate or just completely bypass traditional software providers. So investors are fleeing software and pouring cash straight into the physical infrastructure that makes AI possible. And that specific shift to hardware, it has resulted in this absolutely staggering number, 188%. That is the return we've seen from South Korean equities over just a 12-month period, making it literally the top-performing equity market globally. Now, the crucial point here is understanding why South Korea is winning so big. It all comes down to this number, 80%. South Korean companies currently hold a dominant 80% market share of high bandwidth memory, or HBM. High bandwidth memory is the absolute supply-constrained backbone of the entire global AI infrastructure. They are essentially providing the picks and shovels for the AI gold rush. Okay, Section 3, geopolitics and inflation risks, the global vulnerability. Here is where the story gets pretty complicated. That bear case we talked about, it's colliding head-on with our tech euphoria. With ongoing geopolitical conflicts like Operation Epic Fury in Iran, the Strait of Hormuz is under severe threat. And keep in mind, about 25% of all seaborne oil passes through there. This maps out heavy energy importers who are highly vulnerable to the conflict. And in a massive stroke of geographic irony, two of the nations most exposed to a sudden oil price spike are Japan and South Korea. Yeah, the very nation driving our AI hardware boom could literally have its power cut by geopolitical shockwaves. And look, it's not just about oil prices. The IMF has actually flagged 3 key systemic vulnerabilities if these conflicts persist. First, high debt levels facing rollover risks in core sovereign markets. Second, the honestly terrifying prospect of forced selling by heavily leveraged non-bank financial intermediaries who suddenly face margin calls. And third, massive currency pressures on emerging markets. A localized conflict could easily trigger a global liquidity crunch. Section 4, the April-October danger zone, tracking the cycles. Knowing those macro forces is honestly only half the battle. We've got to overlay them onto historical timelines to see the full picture. We track 2 major cycles, starting with the 4-year presidential cycle. And looking purely at the historical data, staying completely neutral on the politics here, 2026 falls into year 2, the midterm election year. Historically, if you look back over the last century, the midterm year consistently proves to be the weakest, most volatile year for equities in the entire 4-year cycle. It acts like a giant anchor on the market. Furthermore, we overlay the 10-year cycle. 2026 represents the 6th year of the decade. This is a known quantity that typically acts as a volatile tale of two halves. We consistently see this deep weakness form right in the middle months of the calendar, before the market traditionally papers over the cracks with a really strong fourth quarter rally. So when you align the systemic geopolitical risks, the midterm cycle weakness, and that sixth-year decade dip, what do you get? You get the danger zone. Analysts view the window strictly from April through October as hurricane season for equities. If we get a macro shock, whether it's inflation, employment numbers, or oil, this is the window where it historically does the absolute most damage. Which brings us to Section 5, the Asset Allocation Playbook, where to hide.
So, the big question, how do you actually survive this? Right now, there is a very stark contrast in asset valuations. Global equities are looking richly valued and incredibly concentrated at the top. They're stretched relative to the real economy and highly vulnerable. Conversely, fixed income has shifted into an entirely new regime. With attractive real yields and steepening yield curves, fixed income is currently offering an incredibly strong defensive shield that we just haven't seen in years.
Based on that FTSE Russell data, here is your defensive playbook to weather the 2026 storm. Lock in yields with a long-duration sovereign bonds. Shield yourself from supply shocks with inflation-linked bonds. Pivot toward resilient emerging market assets that are showing strong inflows. And anchor the whole shebang with hard commodities like gold and silver for when volatility spikes.
But hey, I don't want to leave you feeling entirely bearish here. This cyclical volatility actually creates immense opportunity. As market analyst Gary Glover points out, the best 15 months of that 4-year election cycle come out of October midterm years. It is the great counterintuitive nature of the market. You often have to run directly into the burning building to get the best returns. The historically turbulent mid-year lows we're expecting often serve as the launchpad for the biggest, most aggressive rallies of the entire cycle. You literally just have to survive the summer so you can buy the bottom. So the blueprint is fully laid out. We're looking at an AI-driven start to the year, a really perilous and volatile mid-year storm between April and October, and then the potential for a massive fourth quarter surge. Take a hard look at this data, review your own strategy, and ask yourself, is your portfolio truly positioned to survive the 2026 danger zone? Thank you so much for joining me for this explainer, and I'll see you next time.